Good afternoon, everyone. My name is Brian Overby. I am the Senior Options Strategist with Options Play. And today we're going to talk about trading with the trend. And we're going to use some tools inside the Options Play / First Trade platform to figure out some trends. And it's a little bit more of a swing trading scenario or looking at momentum within the chart more so than the fundamentals of the company to decide what type of option trades we would like to do. Now, some of the trades that we're going to implement will be short call spreads, short put spreads. We've done many seminars that have covered them and some of the rules that are behind those type of trades. Today is more so using some of the search features inside the options wizard to try to come up with different stocks that you might want to trade. And Thursday after the close, FedEx is going to be announcing earnings. It was one of the stocks that has been in Tony Zhang, the chief options strategist at Options Play, and the research report that Tony shares with you on Tuesday mornings. Usually it's a truncated version of it, but that stock has been inside that, FedEx has, and they're going to be announcing earnings on Thursday after the close. So I'm going to give you a little bit of a bonus trade, and we've done a couple of seminars on butterflies, and I'm going to set up a butterfly, so it's going to be kind of advanced. It's going to be kind of fun today. We're going to all do this in about 45 minutes if we can get rocking and rolling here. But before we get too far, I always have to let you know that it's important that you read the characteristics and risks of standardized options. It's all over the First Trade platform. If you need a hard copy, you can call them up and ask them for it. But nothing that we use today is meant to be a recommendation or advice. We're going to be looking at real-time quotes. We don't know who's available. We don't know our customer that's out there that's watching this event. So nothing that we show is meant to be a recommendation. And realize that past performance does not guarantee future results. All right, that's me. We're going to pop back out. I'm going to run into the First Trade platform. All right, I already set up a couple of trades here that I wanted to look at, but I don't know if you get a lot. I'll go back and I'll show you how to get to this, but from the actual option chains, you'll see something that says Options Wizard. This is the Options Play platform that is sponsored by First Trade inside the platform. One of the first things that you see here are technical ideas that will pop up. One of the problems with technical ideas, and we've been doing a little bit of drill down on some of these, is, there's just too many of them. We need to drill it down, make it a little bit more interesting on how you can find some of the underlyings that you may want to trade. And here we have these two little we have a bullish and we have a little bearish tab. And if you click down on this is actually different searches that will look for stocks that work well for covered calls, look for certain credit spreads that will work, and also short put spreads. I'm going to stay just with the technical ideas today, and I picked a couple of stocks that I want to highlight that will pop up within these technical ideas, and I want to show you a little bit how you can drill down on it. So I'm going to go back to here and we'll start from scratch. I'm going to select all, and I'm going to close this, and I'm going to be like, okay, we logged in, we clicked on Options Wizard, we're now in the First Trade platform. We have 242 different technical ideas that will pop up. I look at that and I'm like, that doesn't really tell me much. That's just too many things to go through. Now, Tony Zhang, the chief option strategist, has gone through and built some trend following scans. I'll let you know that his favorite trend following scan is the CCI trends scan. That's his favorite one, but we also have a counter trend, which basically means looking for falling knives, if you will, if you want to get bullish. In other words, the stock has been really beaten up and it's gotten to a point of exhaustion and it might be time to maybe get long that. That would be a bullish counter trend signal. Or it could be on the other side where the market has skyrocketed and we get all the way up to the upside and we see a bearish counter trend signal. The other one is just trend following. We got a strong trend, market's looking good, let's just hang with it. A lot of times these stocks are trading above their 20, 50-day and 200-day moving average. You're having just a solid move to the upside. Now, depending on if you want to get bearish or bullish, and I'm going to stick on the bull side of things, but we'll look at a couple of bearish positions. But I know most people like to be bullish more than they like to be bearish. So what we're going to do is we're going to remove the bearish side of things. We're going to remove cap size, and this kind of helps with liquidity a little bit too. We're going to get rid of the small cap stocks. We're going to look at medium and large cap and mega cap. And then I'm going to get rid of the not liquid stocks. Now we can go in and we can look at different sectors, and I don't mind playing around with that. We could look in the financial world, healthcare also. If you're bottom fishing sectors that haven't outperformed because of the AI trade, and I don't mind if you want to stick in the technical space if you would like to, or mega cap tech stocks. That's easy. You just make your own watch list and actually kind of apply some of these trends to it. But this is all available to you from clicking right here. Okay, so I have it set up, and I'm going to look at a couple of stocks that came in, and I'm going to talk a little bit about these stocks and look at doing how we might take this information and use it to set up a trade. Okay. If you have any questions, by the way, the Q&A box is open, and the chat box is only for the panelists. So if you do have a question, put it in the Q&A box. I have it down below, and I'm happy to try to address them during the show. We have a decent size crowd out there, and I'd like to make this as interactive as possible. Okay, so here we go. So once we do that, now you see in the middle, first of all, this is not highlighted. This is highlighted because we adjusted it. We got the bullish trades that are highlighted. We see some of these stocks that are in here, and they're not in any particular sector, but we've now narrowed this list down to 98. So this is, we went from 244 all the way down to 98, and we have a solid list that we can deal with. Now, one of the first ones that pops up, and I already took a peek at this one and looked at the chart and we're seeing it kind of a little bit of a follow through on it too. So this one is interesting to me, ExxonMobil. Now, once again, not meant to be a recommendation. I just wanted to try to show you how you can use this in your own trading to try to set up some potential trades. Now, we have ExxonMobil. One of the first things I'd like to look at is just see, is our earnings around? It's 44 days away, so energy companies are usually the first within the earnings period to announce earnings. So this one is already announced now. The next earnings is going to go out to January. They're going to be one of the first ones in that quarter and that period, or earnings season, if you will, out in January. 44 days away. So I do want to keep that in mind, because that's within our range of outcomes when we're looking at doing a short call spread or a short put spread. So we see that we got the bullish sign. We go and we look at the chart, and I'll pull this up, make this a little bit bigger. And inside my studies, I always have the 200, the 20-day and the 50-day moving average in this, and it looks like we're really dancing right around this 20-day moving average, bouncing in and out. Oh, I'm sorry, the 50-day. I got my colors wrong. My 20-day is usually blue and not my 50. But anyways, so it's bouncing right around the 50-day, and it looks like it provided a little bit of support to the downside. But we still have a strong stock, right? In that the 200-day is below. We had the crossover here of the 50-day, the 20-day crossing over the 200. Back here we had the 50-day, that red line is going to screw me up a little bit, crossing over the 200, and that's a golden cross, and that's usually a good thing. That's a sign of a good stock when you got your ducks in a row, the 200, or I should say a good chart, not necessarily a good stock. We got the 200-day trading below the 50-day, below the 20-day, and now we got a bullish trend following. In other words, that we had a strong move to the upside, And now we've had a pullback, and we're basically trading right here, right at the 50-day moving average, which it's came and tested 1, 2, 3, 4. But also, when you have your ducks in a row like that, it's usually a sign that you're going to have higher highs, higher lows, right? A higher high, higher than this high right here, and this low is higher than this low. That's usually a good sign of a chart that's moving to the upside. No sound, no sound, no sound. Seriously? Is everybody hearing me all right? My audio shows that that you are hearing me. Might be your volume on your end. Testing 1, 2. I can hear you. Okay. TRK. You might want to turn your volume up. That made me nervous there just for a second. Do I sound okay? Do I need to go any louder, Justin? Yeah, I'll go a little bit louder, okay? Turn my mic up a little bit. And we'll look at a few more of these. Sounds just fine, okay. And while I'm in here, let's do this a little bit. Okay, so now this is the signal. This is the alert. This is what has triggered this symbol right over here. This symbol means that this is inside the chart. And if you scroll down on the chart, it says ExxonMobil Corporation has received a pullback within a longer-term bullish trend that may provide a favorable risk-reward profile for a bullish trade. And you see it, right? You see the trend. A lot of times when you're seeing this, you are going to see stocks that have their ducks in a row, that are trading above their 200-day and their 50. We've broken below the 20-day, so they're saying because of that, we're seeing an opportunity, basically this pullback here, to maybe get bullish on it. Now, you would be scared because we've touched this a few times recently. 1, 2, a lot of noise there. 3, almost touched it here. 4, that if we break down below this support to the downside, which is the 50-day moving average, that would make you a little nervous, right? You know, you would think that the next stopping point could be all the way down here where this group is, right around 110. But right now we're trading at 116, up $1.73 on the day. How would we want to trade it? Well, want to avoid earnings, so I don't want to do the January 30th expiration because that is when the earnings report is, that Friday of that week. So we're going to go a little bit shorter. And you can decide if I'm not trading around earnings, I'm not looking for a catalyst. Probably the trade that we talk about the most inside the options trade platform is if you're bullish, you want to sell a put spread, and if you're bearish, you want to sell a call spread. So I'm going to go in and I'm going to modify this trade. I don't know why that number is so low right now. We're going to go out 44 days. We'll go down to 37 days. Okay, January 30th. So this must be a Friday. We're going to go to the 23rd. And we're going to be selling something fairly close to at the money. And then let's make it 1 point. Let's go a little bit higher. Look at about on the downside. Yeah, that's not bad. That's not bad on this trade in that, we got to go 37 days here. In that we are buying, the platform has picked out, it's going to default to 44 days out, but we want to try to avoid that earnings. We don't want the increase in implied volatility as we head in. And it's saying we're going to buy the 20 delta. That's going to be our protection. It's trading right around $1.11 at the midpoint. and then we are going to sell a fairly at-the-money option contract, in that we're selling the 116, which is 47 cents out of the money. And we put this trade on, and right now we're pulling in $1.60 on a 6-point wide trade here. That's not a bad risk-reward scenario. So 160 divided by 6, we're looking at 26% of the width of the strikes. That's why the option play score is a little bit low. So this might lead us, we're a little bit low on the options play score. So let me give you a little bit of history on this. We're trading right around 83 on the options play score. We got a low IV rank. So here's how I'm using this platform. Because of that, we're not really getting a lot of juice. We're not getting a lot of premium on this trade. We might have to bump this up a little bit if we want to do a short spread and get a little bit better of a credit overall. And that made it worse, actually. 5 points wide for $1. That's 20 for 109 divided by 5. Yeah, 20% at 109. If we could fill at that midpoint price of 109. Yeah, I don't like the dynamics of a short spread here on ExxonMobil. We're not getting enough of a credit, and it probably has a little bit to do with this IV rank around 6. Now, because that IV rank is low, it kind of leans you towards, if you want to try to do a bullish trade, there's 2 different ways that I would approach it now. All right. Oh, shoot. Well, at least I can show you where it is. Okay. FedEx shows wizard. A good bullish sign on XO. Okay, we'll look at that. We'll look at the XO trade. I see a couple of comments that are in here, and we'll look at that on XO. Okay, so, or is it XOM and ExxonMobil? Okay. So because the IV rank is low, I don't mind actually buying a little bit of an in-the-money call option. Here we're looking at the 115. That's going out. This is probably going to be 47. Yeah, let's look at this trade. 65 days. Okay. $5. We needed to get to 121, which is right up here to break even, but this is 65 days out. If the earnings report is really on January 30th, which that would be a Friday, I want to lean into this trade a little bit, and I think I would look. We'd like to lead. So the 30th is a Friday. They're probably announced before the earnings. XOM. All right, thank you. And Mahesh says that XOM is looking at a decent head and shoulders pattern on a breakout. Got the head and the shoulders, yeah, bounce back that way. All right, not bad. I don't mind. Nice eyes. But we're going out 60 days. Now, here's the thing. I don't want to be in this that long, but if you know implied volatility is going to go up when you see this earnings report on the 30th, now that's also just an indication. We're quite a ways away from that. That date could change, and sometimes it will. Usually a major company is pretty good at sticking to where their earnings date is at, a company like ExxonMobil, but no guarantees. Okay, so this is the trade. This is what I would do. And let's walk through the procedure. Looked at clicking, I just clicked high implied volatility because I wanted to do a short put spread. But there was a red flag that clicked up by seeing a 53 on this trade. Tried to modify it, tried to avoid the earnings report. Looking at the midpoint of the trade, that brings it up a little bit more. And we're still at kind of ugly numbers. So said, okay, why is that? Well, it's that the implied volatility is low, and it kind of shows you this in the IV rank. Even going all the way out to the January 44 expiration, well, this IV rank is based off of a 30-day, but going all the way out, we're still not quite getting that premium. So even if I am a short put spread trader, you can put this trade on, but what the platform is saying that it's not conducive to it, and it's giving that score. Doesn't mean you can't do it. It's just giving you a sign that, hey, if you're receiving $1 on a 5-point wide spread, that's not a great trade as far as option premium is concerned. So, all right, if that's not a great trade, there must be something that the platform likes. So I'm going to go back to bullish. And what's that something? Well, there are two different trades. It likes the bull call vertical spread, and it's going to usually like that more than the long call option, mainly because of the fact that you're selling some premium and buying some premium, and you're hedged on that position. But also, let's go in and let's modify this option contract, and we're going to hit the mid on it. And now we're up to 88, and we're just getting bullish. It's going out 65 days. It's a little bit far for me, but I think I'm going to look at that January 30th expiration. And here's part of the reason why. And 115, I don't mind going a little bit more in the money either. 444, that's not horrible. 64 delta. $7. Let's see what we get from this one. 81. That's a little bit too much. There we go. Let's do the 114. We're going to go down to the 114. $2.50 in the money. We're going to pay $5.23 for that option contract. The delta that we get on that is about 64, which implies that if the stock goes up 1, we make 64 cents on that trade. We got an option play score of 82, but here's the thing that I like about this trade is that we are going out to this expiration, and if we hit trade on this, it will highlight that there is an earnings date. January 30th. It would be the day of that there is an earnings date, and if that earnings date holds true, then we should see implied volatility on this option contract kind of hold steady as we go through the life of the option contract. Implied volatility, we're buying it at a decent low rank. Implied volatility could usually increase as the marketplace approaches. So I don't mind looking at this chart and just buying an XOM option contract, trading with the trend, following the bullish forecast that we have on the trade alert and if you put your mouse over it too, it does also highlight inside the chart that it is a trend following trade alert. But if you don't do that, it also shows it to you down here. Okay, so let's go back, and then it's saying this is the best bet is to look at doing a bull call vertical spread, and they're going to go at 65 days. Let's keep it at the 44 days. Keep it reasonable. Buying the 115, selling the 130. So we'll go up to the 115 from the 114. Modify this, risking $380 per 1-by-1 spread to make 1,100. That's I understand why it's given that number, a solid number. So 383 times 3 is 1. So that's almost triple the amount. Yeah, that's not bad. You're bringing in 64 cents on the 130. You're giving $3.83 of risk to make $1,117. It's a very solid risk reward, and because of that, it's highlighting 106 options play here. It's not a bad way to do it. I personally would lean with just the long call. That's the way that I would go with it. It does not like the short call spread, not bringing in a ton of premium because IV rank is low. Any questions on that? All right. Happy to go through the trades. Do you have any questions about the particular strategy? So I personally would lean towards this trade, just buying an in-the-money call option, 104, getting about a 64 delta, paying $5.23 for it. Maximum risk would be $523. And I don't plan on being in the whole 44 days. If we get I'd look at the chart, the move to the upside here, 120 level, look to get out. That's where I would be. If we do show a clear breakdown, 113, 112 on the downside, right in here, there's a little bit of noise. Yeah, right here, 1, 2, 3, 4. Let's see where the trend line comes in. Yeah, I think there's also a trend line right in here too, right across the top here. That would be the area that I would look to try to get out, which is right around, yeah, right below the 50-day moving average. Okay. Apple. Got the same type of trade here. So let's look at Apple. Let's get a little bit stronger. It is showing that the relative strength is a little bit negative, but in Apple, once again, we have another trend following signal. Apple has recently experienced a pullback within a longer trend. Apple are bullish, mildly bullish. IV rank is still a little low, so high implied volatility. Yeah, this is still going to be a little rough. Let's modify this. Let's look at that. 44 days out. Earnings January 29th, 43 days out. Short put spread. Let's go down to 30. Usually Apple's got enough premium to make this interesting. Yeah, 10 points why we're not quite there either on the Apple trade. 279 is the midpoint. We'd like that to be around 330 on a 10-point wide spread. So this, once again, is the same scenario. We got a bullish trend following. We got the IV rank fairly low, not getting a ton of premium. So then if you want to get bullish, according to this, you'd either look at doing the bull call spread or the regular call spread. So here, let me look at one other trade and let me talk about just this trade. That's not a bad way to go around a trend following. If you want to do a short-term trade, and you see here, it looks like we're right at according to the platform, we're at an area, well, we kind of broke down a little bit. We broke below the 20-day moving average. 50-day is down here, and we got a bullish line here. Trend following. If you want to do the short-term trade, and once again, a very solid chart, and this has a tendency to happen, right? We're above the 200, we're above the 50, and we're hanging around the 20. Higher highs, higher lows. Higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, and now we're bouncing back within that, and we're danger coming back down towards where this is at, and almost looking to try to build a head and shoulders again, that was mentioned before. And if we get this breakout to the upside here, a way to do a trade that takes time premium out of the trade is to look at surrounding the underlying stock. We're going to look at doing a bull call spread based off of this trend following signal, and I'm going to just straddle the stock. I don't need any fancy tools in here in order to pull this off. I don't necessarily need to look at the options play platform. All I'm going to do is go equidistance in the money, equidistance out of the money. And if I do the trade that way, I'll be buying about as much time premium as I am selling. My break even will be very close to where the stock is at. And I'm just basically saying, I think we're going to get this trend following move to the upside, and I'm going to do it shorter term and hope that my forecast is correct. Okay, so let's modify this trade. 273, so let's go 273, 270. It'd be nice if it was right at a strike, but it's not going to be. Let's go 16 days. So we're just giving this enough time to play out this trend following move. We're going to go a little bit in the money. Yeah, good. We got the 267.50. So that's about a little bit more than 5 points. And then we're going to go about 5 points up. So 278. So we're probably got to go to the 280. right? And click trade. Okay, so 267 is a little bit more in the money than the 280 is out of the money. The cost is $6.25. The width between the strikes is 280 minus 267.50. We're close. $12.50 is the width between the strikes. Okay, so if you're going to take time premium out, you want to pay half of that. So you divide that by 2, that would be $6.25, and we're at $6.29 on the midpoint for this trade. So if we did this trade, and let's go back, let's hit this, hit trade, and we were able to fill at the midpoint, which is the difference between the two. It's never a guarantee that you can fill there. And don't forget, you got to add in any fees to get in and out of the trade. But 629 is where it's at. You take that and add that to this, and that's your break even. So 6.29, if we filled at the midpoint, plus 267.50 means the stock needs to be in 16 days in order to break even at 273.79. And right now the market is at 273.21. So why would I do this type of trade? One of the biggest battles when you're trading options is to deal with time decay. If you go equidistant in the money and equidistant out of the money, in other words, you straddle the stock, you are buying as much time premium in that instance as you are selling. So you have a very short-term trade, 16 days, and now it's all about price movement. You don't have to worry about implied volatility fluctuations. You don't have to worry about time decay. It's going to affect the trade. It's still out there. It's still available, but you own as much time premium as you have sold. And that also means that if the stock goes nowhere, well, we need it to go a couple of cents, right? We need to go up to 273.79. And then we can just break even on the trade. If it goes down, I still have the risk. If it goes up, I still have the risk. But this means that I'm totally playing just this trend following strategy by doing the trade. Now, you want to use this as an entry point? You know, once again, I would go back and I would lean toward just doing the long call in that scenario. And that's where I would look to do and go a little bit in the money, look at around a 60 delta or so. I don't need to go out 65 days. Once again, I'd probably avoid that, cut that down a little bit. I don't need to pay that much more from premium, but that, you know, that's not a bad scenario to go through either. Okay, now let me see if I can get one more technical idea. And the hardest one to pop up is the CCI trend. So I'm going to remove this trend following. I'm going to remove this counter trend. And we're going to still lean bearish or bullish. And we got to get rid of, let's get rid of this. And it would be really nice to do liquid. We'll get rid of the small cap. Let's just try liquid, okay? See how many we end up with. Procter & Gamble shows up as a bear. Oh, I didn't get rid of the bear, so we're just looking at the bullish. So now, because Reddit, man, that's a volatile stock. I'm not that excited about that one. Coherent, AppLovin. Well, we're in the tech space. CCI dip. IV rank is low. $600 stock. Yeah, this wouldn't be a bad one to do. It says we got some liquid options. Zoom in on the chart here. These are the support and resistance lines. I'm going to open them and I'm going to add them back in. Support right at this level. Okay. It's not, see now, here's the difference about you instantly see, just looking at the moving averages, that this is not obviously a stock that has done well. It's not, you're not following the trend. But we have a momentum trade, and that's what CCI is. It's similar to the most popular one, which would probably be RSI. And this does a calculation based off of what has what the momentum has been in the short term versus the momentum in the long term. Tony has done a few videos out there. There are a few out there that talk about this indicator. There, you don't see as many pop up, and part of the reason why, though, is that we adjusted it. We got rid of, we want very liquid and not somewhat liquid, and we also got rid of the small cap. But we're looking for CCI trend. We can even get rid of the bearish trades if we want to do that. We're trying to get bullish, all sectors, and now we've, so think about this. We went all the way from 240 technical stocks to now whittled it down in size to stocks to 3 different stocks that are very liquid underlyings that have the, and there might be 0. You know, right now, if you were trying to do a bearish trend, there's only one that pops up on the bear side of things, and that's Procter & Gamble. All right, so here's where we're at, app 11. The way I would trade this one, especially because it's an expensive underlying, is I would try to do the trade that we just talked about straddling the stock. So we're going to go on in. Let's modify this. We'll go equidistant. Oh, this one's nicer in that it's right at a strike. 675 should be a strike price that we'll be looking at. We're going to go out 16 days because, once again, it's all about this trend following signal, the CCI trend. And we're going to click trade. So let's click trade. Let's modify this. Hit that. Go down 670s. And this would be, I'd go down quite a bit. I mean, it's an expensive stock, so it's, I mean, you might go a little bit wider, but I'm going to keep it simple. Keep it inexpensive relative to the total cost, okay? 680. And the stock moved on me a little bit, but we are 100% straddling the stock here. 465 plus 670. We're actually selling, and that probably has to do with the price a little bit, but we're actually below where the underlying stock is at. 465 plus 670 means that our break even is 474.65. 474.65, and the market is here. But 50-50 choice once again. So we've bought less time premium that we sold. Even though this is a debit spread, we have our break even below where the underlying stock is at. Taking the time premium out, making it all about the CCI signal, and we hope it goes up 5. If it goes up 5, we hit our maximum. If it goes down 5, we lose our maximum. So we're going to do this on a very speculative basis, on a short-term trade, based off of the fact that we got the CCI symbol and dip. All right, I don't see any more questions on in there, but this is how you can use some of the trend following apps inside, or some of the technical analysis and trend following searches inside the First Trade Options Wizard to help you pick out some strategies that you might be interested in doing. Okay, now I wouldn't mind going back. Let's try one last one here, because I kind of want to find these are leaning towards very low implied volatility. They're not around earnings. Let's go somewhat liquid. Let's try discretionary. Discretionary is interesting. Health and technology. Let's try that one. And put them all back. Bullish. IDEX Laboratories. It's another expensive one. Edward Life Sciences pops up, but that's not a real liquid. Looked at the stock. Yeah, that's somewhat liquid. Let's get rid of somewhat. Let's see how many pop up if we get rid of somewhat. Medtronics. Vol is a little higher. Bullish. Bullish trend falling signal. We really pulled back here. Got a strong support there, but it looks like the market, well, here, yeah, this is real interesting in that here's the gap. Right, well, it's not that big of a gap, right? From here to here is our gap scenario, and we're right down to the bottom of that gap, and we hit the 20-day. But man, this is really trying to catch a falling knife on the downside. And here's the 200 down below. That is a real interesting point in this underlying stock right here. We filled the gap, came from this range all the way down to here. We're right at that area of support, and that's actually drawn by the platform. And then also we see the 50-day moving average right here. I don't know much about the fundamentals on it, and that would be a little bit more interesting to dive into a little bit of that. But one, how many down days? So we were saying that we got to a point of exhaustion right here. Interesting. I don't like that it popped up 75, 44 days, 96. Yeah, that won't be bad. 3 points wide. So yeah, that's not bad at all. Okay, so I would widen this out a little bit, but we're selling the 98, which is the more at the money, buying the 95 strike in the healthcare sector. Obviously, trades at decent valuations overall. I don't know much about Medtronics. I would want to look a little bit more into the fundamentals of the company. Obviously know the company well, and it's a very popular company that is available. Let's pop out and see. So the stock does have a lot of volatility within the range. It didn't quite come down to the 200-day here. This is another trend line down below. But it's really maintained that 200-day moving average. Once it broke out here all the way back in June, we haven't really even came back and tested it very much. Interesting. Okay. It's an interesting underlying. Decent volatility has had to have spiked on that bigger downturn. We see the IV rank a little bit higher. You're bringing in $1.30 on a 3-point wide trade. So if we do the math, the options play platform is showing you that it's not a bad trade. It's almost 100. It's just 100 would be green. We're at 96. But more importantly, we're bringing in a dollar on a 3-point wide trade. When we were looking at the other trades, we were bringing in $1 on a 5-point wide trade. Does that kind of make sense? You're just not getting as much premium as the options play platform would like you to get if you're looking at doing a short to put spread. So $1.13 if we fill at the midpoint divided by 3 is 0.37. So we're bringing in over a third of the width of the strikes. Trend following. What do you guys think? Any comments? Any questions? This is how to use the platform more. All of this is available to you as a first trade client. Other ones that are interesting, consumer discretionary, going into the holiday, consumer services, non-durable. Well, let's look at consumer services. See what that does for us. Somewhat liquid, bullish. Series XM pops up. Well, good to see that it's not a $5 stock anymore. This stock has really struggled with the light of Pandora and everything to go along with it. Yeah, I don't really like that space or that area. CBOE, company that I used to work for. Cboe Global Markets now is what it's called. The only thing I don't like about this is I do like the underlying stock, and we got a trend following signal. Pop below the 20-day for a second. So right at a support area here, according to the chart. And this is a trend following. Bullish trend following. It's recently experienced a pullback within a longer term bullish trend, I guess. I don't know if that trend is longer term, right? Because it's only from about here to here. But if we go all the way out, yeah, I guess you can make that argument this way. Yeah, that liquidity is not there. So I would look in this scenario to do the bull call vertical or buy the long call. But trading stocks, CBOE, NASDAQ, they've had good markets. They've done well. Option trading is getting popular, more and more popular. So it's an interesting underlying to do this in the technical space. Let's see if there's, then you can even drill down, get rid of these, and see if any CCI trends pop up. Lemonade, which is an insurance company. Currently a bullish trend and recently received a short-term price pullback. What's the liquidity? Somewhat liquid, so you'd kind of struggle a little bit if you're buying options outright. IV ranking is not horrible. 76 though, let's modify that. Boom. 92, bring it into, let's go 37 days out. 103. $5 on a $11 trade. Yeah, that's why it's getting a decent score. So man, that was quick, right? This is an insurance company. Insurance companies, well, I mean, overall, they've done well. This is an insurance company that focuses on technology and an online app and has had good reviews, good solid trades. This was obviously a nice trend, and here was a great signal here when we got that breakout to that, came back, traded within the trend. Now it looks like we're trying to break out again to the upside. Yeah. Right, but we failed. So this would be a breakout to the upside right here. CCI trend. Put vertical, you're bringing in $5 at the midpoint on a $11 wide trade. That percentage is real strong. 507. 11. 46% of the width of the spreads. Bullish short. Wow. That is an interesting trade, and hence the reason why it's green. Almost a 50-50 risk reward, selling and out of the money. Yeah, 82, we're 21 cents out of the money put spread on it. You could even bring that in and reduce the risk a little bit more. Let's 37. I did everything right. What do you guys think? That was interesting, right? Yeah, transportation is all right, but there, man, the thing about Mahesh, the thing about transportation is, gosh, we're struggling just finding some vol in some of the stocks that we're looking at. So in transportation, it's going to even be worse overall. And I've gotten long, so I'm going to let this go. But this, we drilled down to this trade, and I'm not saying that Lemonade Inc., an insurance company, is the best place to be. But if you're just looking at an option trade based off of the dynamic, based the way that the options are priced, it's somewhat liquid, so I'm not really sure if we can trade close to that midpoint. But if we do get that midpoint fill, options play is showing you that this is a solid score. And you think about this, you're out of the money, and you have a almost the risk, the reward to risk ratio is crazy, right? 507 is your reward versus your risk of 593, 0.85. for every dollar that you risk. That is just a really good reward to risk ratio, or you could flip the script and say risk to reward ratio on a stock that, with using a strategy where you just want it to be neutral, stock stays where it's at, that's good, to bullish on that trade. So very interesting underlying. All right, that's it. Let us know if you like it. If you don't, I still see we got quite a few people. Everybody kind of seems to stick around. If there aren't any last questions, I'm just going to pop my little info slide back up and let you know my name is Brian Overby. I am the senior options strategist at Options Play. If you want to follow me on x.com, my handle is at Brian Overby. My little book's called The Options Playbook if you'd like to learn more about the strategies that I like to talk about. And thanks for stopping in.